In a week that's already seen massive volatility off the back of the DeepSeek news, we've also got earnings from 4 out of the 7 Mag 7 names, and we've got rate decisions from the likes of the Bank of Canada, the ECB, and the FOMC. The week ends with a flourish as the US prepared to release the latest Core PCE price index. And certainly, given fears over a reflation move in the US and what that could do in terms of interest rates and the trajectory under the Fed, it could be a late fizzle that we see within the markets and that we end the week with significant volatility. So let's look into this release and I'll show you exactly why it's important. So like I said, this is going to come hot off the heels of the FOMC meeting. And certainly there's a lot of discussion about what will that FOMC meeting look like. It's probably going to be relatively hawkish in nature, very much data dependent. They're going to remain on a patient approach because they don't actually know what Donald Trump's presidency will do in terms of inflation. There's massive question marks whether it comes to his policies, tariffs, and the like. And so it just doesn't make sense for them to suddenly start to ramp up the easing in a meaningful way. Now, the economy appears to be in decent shape, but inflation is the key thing here, right? And we've certainly seen some signs recently that we could be somewhat fearful around, and that builds the basis for a more patient approach from the Federal Reserve. So this is what we're looking at in terms of the data for this meeting or around this release. Excuse me. So we can see here that the core PCE price index is expected to come in on a monthly figure at 0.2. That's up from 0.1 last time around, keeping the year-on-year metric at 2.8, which is at the bottom of this. We've got some other interesting parts, which are the personal spending, personal income, employment cost figures, and of course those sort of PCE rather than core PCE. But of course, the core PCE metric is the Federal Reserve's favored inflation gauge. So this is going to be an important one. Now, part of why we're so fearful around it and around the sort of reflation move is because of what we're seeing over on the CPI side of things. And this is the comparison between core CPI and core PCE. Of course, very different metrics. And so when we see a surge in terms of core CPI, you're going to think that we're probably going to see the same kind of thing in terms of PCE, because that just means that inflation is resurfacing. And we can see here that on the top end, core PCE 2.8, core CPI 2.9, but it's that trajectory because PCE has largely been sort of flat. We haven't seen a massive uptick over the course of the past 6 months. We have seen it sort of grind higher, but that move from the September low on the core CPI metric is very notable. And so that does raise significant concerns. And you can see it on the monthly sort of bars in the middle of this chart, where we've got the two green columns on the right with 0.3 and 0.4. Of course, that is well over and above the kind of monthly figures that are consistent with their move back down to target. We haven't necessarily got that in terms of the core PCE. In fact, if you look back from May, the numbers have been relatively under control. You can see a couple of them have been over, a couple of them have been under, but none of them are really sort of massive figures. No 0.4s, no 0.3s, or certainly not all the way at 0.3. You know, you might see it as 0.3, but it comes out at 0.25 or something like that, certainly. So we're looking here at a core PCE metric that could actually tell a different story from what markets are currently fearing around this reflation move. You can see on the bottom end that 3-month annualized highlights that recent surge in terms of the CPI, the core CPI number, that just hasn't happened with the PCE metric. 3.87 and 2.54. That disparity between the two is really growing heavily. And so the question mark here is, does the core PCE reading continue on its recent vein, which is that it's, you know, tracking around where we need it to be in the sort of mid-twos area, or do we see it follow on that trajectory that we're seeing, that upward trajectory on a monthly basis for the core PCE? Bear in mind, a lot of the upside that we're seeing recently in terms of inflation has been coming around energy. In actual fact, Trump's managed to drive that down a bit, but certainly, you know, that has been, of course, stripped out when we're looking at these core metrics. Now, one thing that certainly has been a big concern recently and really sort of was a bit of a shock to the markets was a jump in the ISM services PMI prices paid element. This is probably a bit of a mess of a chart to some of you, so let me explain it right. So the prices paid element is the blue line. And so what we want to see is that the prices paid as noted by those within the services sector, how is that leading inflation? How is that leading the core PCE metric in the past? And what we can see is when we saw this resurgence in terms of or surge in terms of the prices paid element that we can see in the middle of this chart, which is sort of roughly around 2020. That, of course, leads all of these metrics. So essentially, you're going to hear from the person on the ground, which is these PMI surveys, before you see it showing up in your 12-month inflation metric, or, you know, you might start to see it on the monthlies. So what you would expect is the prices paid moves upwards first or downwards, as you can see here. When it rolled over first. Then we would likely see the 3-month annualized move lower. Then we'd see the 6-month annualized move lower. Then we'd see the slowest to turn, the 12-month inflation metric, move towards the downside. So what are we seeing at the moment, right? So are we seeing that 3-month annualized figure moving towards the upside and following on from that warning shot that we saw from the ISM services PMI prices paid element? Well, not yet. You can see here all three of those core PCE sort of derivatives have all remained relatively flat and consistent with sort of where we've been over the course of recent months. But this could perhaps be the moment that we see that kicking in. So this is why this is so important, because markets are fearful of something that at the moment isn't happening, certainly when it comes to the PCE metric. And so if we suddenly see a surge in terms of this sort of monthly figure on the core PCE, suddenly we start to say, yeah, what we're seeing on the CPI side is happening. And this warning shot that we saw from the prices paid element of the services PMI is consistent with what's happening in terms of the PCE figure. But it's not a given that it's going to happen, because as you can see, by and large, we've seen a lid kept on this figure. So it's really going to either inform us that that prices paid element was right and we're now starting to see a resurgence in inflation, or this is going to dispel that and start to make people feel a little bit more confident that we're going to see more rate cuts. Now, interestingly, we have seen a shift over the course of the past few days, and that's because of this massive sell-off that we saw led by Nvidia around the news that DeepSeek had essentially managed to do AI on the cheap, and it starts to really raise questions about the validity of the valuations around some of these big tech stocks, notably Nvidia. What's the point in buying these super expensive chips and buying all the latest chips when seemingly you can just do it with some old chips and just do it at sort of playing smart? That, you know, of course, we're looking for greater clarity over that, because we don't necessarily know that they were doing it on cheap chips. They might have just done it on decent chips, but they've just shipped them in behind the scenes, and they don't want to make it obvious that they've bypassed those export controls that the US holds on chip suppliers for the sort of top end chips for Nvidia and the like. But what we have seen here is a shift in expectations away from the idea that we're not going to see rate cuts over the course of this year, away from the idea that we're going to see just one rate cut this year, which had been the base case scenario, and towards the idea that we see 2 rate cuts, 3 rate cuts. So we have, over the course of this week, seen a significant shift in expectations. Now, of course, I'm recording this prior to the FOMC meeting, so that in itself is going to inform us just how much they really care about what the markets are doing. And your likes of Nvidia and the like. But certainly this is notable, a potential shift on the dovish side, which could have implications for the US dollar. This is the US dollar against the Australian dollar. I could have chosen a number of different ones here, but, you know, I think this one's an interesting one. The Aussie Australian inflation's been sort of coming down recently, and they've been sort of pretty hesitant to move. But what's notable here is, in actual fact, why I also like this is if you look at the two-year swaps, so that sort of forward-looking inflation expectations for Australia, and you compare that to the US, we haven't necessarily seen huge volatility on Australian side, but we have in terms of expectations in the US. And that means that the likes of, and you can see here, the differential between the two essentially informs us where Aussie dollar's going. So that means inflation expectations on the US side are the dominant driving force behind where this pair is going to go. And that means if you see this sort of tightening, so if you see weaker expectations in terms of US inflation, so if we don't see a sort of surge in terms of core PCE, and bear in mind, we're expecting 0.2 metric, which is in line with that, right? Which is in line with us sort of staying on track and getting down to target soon enough. If we see those kind of metrics, then again, you could see that two-year swap moving towards the downside in terms of the US. And that could mean that there's a sort of narrower differential between the two, which would mean a rise in terms of the Australian dollar against the US dollar, as you see on the bottom. So it's these inflation expectations that really are driving things when it comes to this currency pair. So let's bring up the chart for that currency pair and see exactly how things are playing out at the moment. So we can see here that rebound that we're sort of mentioning of is this move here, right? And it's taken shape since the lows in sort of mid-January, and we're sort of rolling over at the back end of this month. Certainly, you know, you're looking at a wider sort of bearish trend that's been dominating over recent months. But the question mark here is, do we see that sort of weak inflation gauge coming out of the US? Arguably, like I said, there is a case to be had to that you'd say that even coming in line at 0.2 inflation would be decent. To be fair, that could point towards the Federal Reserve being able to cut rates by a decent amount over the course of this year as markets are starting to price. But we're starting to sort of weaken a little bit of late as the US dollar is coming back into strength. Look out for this to potentially represent a retracement. If it was the case, you'd be looking at 0.622, 0.62. And, you know, the question mark here is, have we bottomed? And certainly, you know, you're looking at a protracted move towards a downside here. But we have come through a notable swing high with that break up through this 0.63 handle. So quite significant consolidation here. Rebound, that pop and rejection into the new low, but that rally up through the 0.63 mark does point towards the possibility that this pullback is a pause before we push higher once again. And certainly we'll be looking for weak inflation data to inform us of exactly that. The caveat here, of course, is we have the FOMC leading into this. So if the FOMC come into this and start saying, yeah, we're going to be very patient, we don't think we're going to be cutting rates anytime soon, then you could see some strength in terms of the US dollar, weakness in terms of Aussie against the US. But remember, that then leads into the inflation figure on Friday. And like I said, the key thing here is that the Fed is going to be guided by the data. And if core PCE inflation on Friday comes in weak, then the data-dependent approach that people might be sort of worried about a day earlier, I think it's 2 days earlier, suddenly goes out the window, right? Because they think, okay, well, they're data dependent, but the data's coming in where inflation is moving back down to target. So you could quite easily see a sort of two-pronged move with the reaction around the FOMC and then the reaction around this core PCE. But it's certainly going to be a really notable move in that you're looking to see shifting expectations in one way or another, because right now markets are very fearful about a reflation move. That ISM prices paid element on the services metric, that has been a significant warning sign for markets. They're already fearful about what Donald Trump might do, but arguably, despite the fact that he's coming out with, you know, 25% on Mexico, 25% on Canada, 10% on China, you know, arguably you're talking about neighbors that he's probably going to be able to strike a deal with soon enough in terms of Mexico and Canada, and he's laying the groundwork for discussions with them. And then the big one was China. And if he's just talking about 10% and then also coming out saying that he doesn't really want to implement tariffs unless he has to, and bringing TikTok back in, then, actually it's a bit more of a soft tone compared to how many had perceived it to be. I have said all along, there's also the caveat that inflation right now is all services led, it's not goods led. And therefore, if you put tariffs on goods coming into the country, you might see some reflation. But as long as services inflation moves towards the downside, that's key. And that's why that ISM services prices paid metric rebound was particularly notable and concerning, quite frankly. In terms of another market to watch out for, it's the Dow. And the Dow's a really interesting one, because whilst we saw the likes of the S&P 500, so let's see, US 500, we can do all of them same, and US 100. So if you're looking at the likes of the Dow compared to the likes of the NASDAQ, and here we go, the likes of the Dow against the NASDAQ and the S&P 500. Well, what happened as we kicked off the week? Really sharp declines for both of those two, the NASDAQ and the S&P 500. But the Dow Jones just continued to climb. And it really highlights the fact that this fear around the sort of tech sector and around valuations associated with it, and the move for sort of DeepSeek and cheaper AI, that isn't necessarily something that hits the market as a whole, because it might benefit most companies. Most companies need to get into AI, and that's their way of being able to grow at a faster clip and make themselves more efficient and bring down costs, and you name it. It's not given all of them will be able to do so, given the sky high costs. And also, you are looking at a sort of prolonged implementation phase where we wait for the costs to come down, because at the moment you're looking at these companies spending hundreds of billions on it. Well, what if the costs come down now and we've just seen something announced that creates the basis for making AI more accessible to all? That, by and large, from a business perspective and a growth perspective, is good for the market, but bad for specific names. So yes, there is a risk for your likes of NVIDIA and the like, but it might not be bad for the wider market. And that's why the Dow has actually enjoyed a lovely rebound off trendline support. You can see here now heading back up towards record highs. There you go. So 45071. And so if you add to that the idea that we're seeing greater expectation from markets that we will see a additional 1 or 2 rate cuts this year, as we've seen that started to get priced in. And then you see Friday's Core PCE price index reported, and if we do see a move of 0.1, 0.2 on the monthly figure, then all of those fears around the likes of core PCE, core CPI, and to an extent CPI, they start to fade. Also, with the fact that energy prices are moving lower, so core CPI is going to likely be controlled to an extent by the downside we're seeing in energy prices, and then the core CPI figure, well, essentially headline CPI and core PCE are more important, core CPI less so to the Federal Reserve. And so it opens the door for greater easing. So that all provides the basis for potential strength here when it comes to the Dow. So look out for your near-term swing low, which I guess would be sort of around this 44077, but we're seeing sort of nice moves towards the upside at the moment. Another way is sort of playing it with, because that looks like kind of like an outlier move that we've seen on Monday. Otherwise 44265. But at the moment we're just gradually grinding towards the upside, and this market just looks very normal. You wouldn't think within this that we'd seen what people were perceiving to be a market crash and the biggest daily decline in market cap on record with NVIDIA. So things are a bit different depending on the market that you're looking at. And certainly this Core PCE price index report on Friday will be really key. And I've shown you exactly why, because it either follows what's happening in the prices paid services ISM number, PMI, and the CPI resurgence, or it doesn't. And it actually points towards the Federal Reserve being able to be data dependent, but that's a good thing. And that points towards them potentially easing to a greater degree, particularly in the second half of the year. I hope this has been useful. We'll be producing lots of content like this as we go forward. Make sure to like, share, and subscribe. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day.